Here's what's happening. If you live in Westchester County, New York, and you're paying $35,000 annually in state and local taxes, you just received a $30,000 federal tax deduction increase. In the 32% federal bracket, that's $9,600 in annual tax savings. But if you live in Dallas, Texas, with zero state income tax, you receive absolutely nothing from this change. Zero. I'm looking at the most controversial tax change in decades. And it's creating a geographic war that most Americans don't even know exists. The SALT deduction cap just exploded from $10,000, and I'm watching as this single provision redistributes wealth on a scale that would make even the most progressive politicians blush. The One Big Beautiful Bill didn't just raise the SALT cap, it created the largest wealth transfer mechanism in modern American tax history, moving money from low-tax states to high-tax states, from middle-class families to affluent coastal residents, from renters to homeowners. And the most disturbing part, it's all being funded by borrowing that every American taxpayer will eventually have to repay. Let me walk you through the mathematics of this geographic inequality, because the numbers are staggering. The Joint Committee on Taxation estimates that raising the SALT cap to $40,000 will cost $600 billion over 10 years. That's $60 billion annually in lost federal revenue. But here's the critical detail nobody's discussing. 40% of those benefits flow to households between the 95th and 99th income percentiles. This isn't middle-class tax relief. This is a massive subsidy for the wealthy disguised as geographic equity. The geographic distribution reveals the true nature of this policy. The 10 counties with the largest SALT deductions are concentrated in the New York metropolitan area and San Francisco Bay Area. These are some of the wealthiest communities in America, with median home values exceeding $1 million and household incomes well above national averages. Meanwhile, taxpayers in states like Tennessee, Florida, and Wyoming, many of whom deliberately chose to live in low-tax jurisdictions, are now subsidizing the tax preferences of coastal elites. I've been analyzing IRS data from 2022, and the patterns are clear. New York had the highest difference between what taxpayers wanted to deduct and what they could actually deduct under the $10,000 cap. Minus $43,200 per affected taxpayer. That's more than 20 times the comparable figure in Alaska, which was $1,900. We're not talking about minor adjustments. We're talking about fundamental restructuring of who pays for federal government operations. I want you to understand what this means for tax competition between states. For decades, Americans could vote with their feet, moving from high-tax states to low-tax states to improve their financial situations. The SALT expansion undermines that competitive pressure by making high state taxes partially deductible against federal obligations. It's essentially a federal bailout for state and local fiscal mismanagement. But here's where the analysis gets really disturbing. The SALT expansion creates perverse incentives for state and local governments to raise taxes, knowing that federal taxpayers will effectively reimburse wealthy residents for a portion of those increases. A family in Greenwich, Connecticut paying $45,000 in state and local taxes can now deduct $40,000 instead of $10,000. That additional $30,000 deduction saves them $7,200 annually depending on their federal bracket. The phase-out rules reveal just how carefully this benefit was designed to avoid middle-class taxpayers. The $40,000 cap begins phasing out at $500,000 in modified adjusted gross income, with the deduction reducing by 30 cents for every dollar above that threshold. By $600,000 in income, you're back to the old $10,000 cap. So this benefit targets exactly the households earning between $200,000 in high-tax states, minus precisely the demographic that was most vocal about the original SALT cap. Meanwhile, a similar software engineer in Austin, Texas, earning the same $350,000 salary pays zero state income tax and perhaps $12,000 in property taxes. They can only deduct the $12,000, receiving no additional benefit from the cap increase. But here's the critical part. Both engineers are paying into the federal system that funds this subsidy. The Texas resident is literally paying higher effective federal taxes to subsidize the tax preferences of the California resident. Let me give you a concrete example of how this redistribution works. A software engineer in San Jose, California, earning $350,000 annually, might pay $28,000 in state income taxes and $18,000 in property taxes, totaling $46,000 in SALT obligations. Under the new rules, they can deduct $40,000 of that against federal taxes. In the 32% bracket, that saves them $9,600 annually compared to the old $10,000 cap. The regional data makes this wealth transfer undeniable. According to the Tax Policy Center analysis, states like New York, California, New Jersey, and Connecticut will capture the vast majority of SALT expansion benefits. These same states already receive disproportionate shares of federal spending relative to their federal tax contributions. The SALT expansion exacerbates this imbalance, making high-tax blue states even more dependent on federal fiscal transfers. But there's another dimension to this analysis that's particularly troubling. The SALT deduction primarily benefits homeowners in expensive metropolitan areas, while renters and residents of affordable housing markets receive minimal benefits. This creates a federal subsidy for expensive housing markets, essentially encouraging geographic concentration of wealth and contributing to housing affordability crises. The local portion of the SALT deduction reveals even more concerning patterns. Research shows that communities benefiting most from SALT deductions have high home values, low poverty rates, and relatively homogeneous affluent populations. We're using federal tax policy to reward economic segregation and geographic inequality. Here's what really concerns me about the fiscal mathematics. The federal government is already running $2 trillion annual deficits. Interest payments on the national debt approach $1 trillion annually. The SALT expansion adds another $60 billion in annual revenue losses, funded entirely through additional borrowing. We're asking future taxpayers, including residents of low-tax states who receive no SALT benefits, to service debt incurred to provide tax relief to affluent residents of high-tax states. I'm also tracking the revenue impact on state and local governments, and the incentive effects are problematic. States like California and New York now have reduced pressure to control spending or moderate tax increases, knowing that federal taxpayers will partially subsidize the burden on their wealthy residents. This moral hazard could lead to even higher state and local tax levels over time. The temporary nature of the SALT expansion creates additional planning complications. The cap increases to $40,400 in 2026, then rises by 1% annually through 2029, before reverting to $10,000 in 2030. This sunset provision will create massive tax planning opportunities for wealthy taxpayers who can time income recognition and deductible expenses around the expiration. The compliance complexity is another hidden cost that disproportionately affects smaller taxpayers. The new phase-out rules require sophisticated tax planning to optimize. Wealthy households can afford professional tax advice to structure their income and time their deductions for maximum benefit. Middle-class families without access to such expertise may miss optimization opportunities or make costly mistakes. But here's the political reality nobody wants to acknowledge. Once these benefits are in place, they become extraordinarily difficult to repeal. Wealthy voters in high-tax states will organize politically to extend the SALT expansion beyond 2030. The temporary provision will likely become permanent, creating a lasting federal subsidy for high state and local taxes. I've been analyzing the distributional effects by income level, and they're stark. For households earning $50,000 annually, the SALT cap effect was minimal even under the old $10,000 limit. Most middle-income families in high-tax states don't itemize deductions or don't have sufficient SALT payments to be meaningfully affected by the cap. The expansion primarily benefits households earning $200,000, exactly the demographic that needs federal tax relief least. The international implications are equally troubling. The United States has long advocated for international tax competition, arguing that jurisdictions should compete on tax policy to attract mobile capital and residents. The SALT expansion undermines this principle domestically, using federal policy to reduce the competitive advantage of low-tax states. From a constitutional perspective, the SALT expansion raises serious federalism concerns. Federal tax policy is being used to subsidize specific state policy choices, effectively coercing federal taxpayers in low-tax states to support higher spending levels in high-tax states. This distorts the federal-state balance and undermines fiscal accountability at the state and local level. The estate and wealth planning implications amplify the geographic inequality. Wealthy families in high-tax states can now deduct larger amounts annually, leaving more wealth to compound and transfer to future generations. Meanwhile, families in low-tax states receive no comparable federal assistance with their tax burdens, creating long-term wealth accumulation disadvantages. The economic efficiency effects are particularly damaging. Tax economists have long recognized that geographic tax competition improves government efficiency by creating pressure to deliver value for tax dollars paid. The SALT expansion reduces this competitive pressure, allowing high-tax jurisdictions to maintain inefficient spending patterns while shifting part of the cost to federal taxpayers. Compare this to a similar family in Nashville, Tennessee. Earning the same $400,000, they pay zero state income tax and perhaps $8,000 in property taxes. They receive no additional federal tax benefits from the SALT expansion, yet they're contributing through higher federal deficits to fund the tax relief provided to the Manhattan family. I want to break down the real-world impact with specific examples from major metropolitan areas. In Manhattan, a family earning $400,000 annually might pay $32,000 in state income taxes and $25,000 in property taxes, totaling $57,000 in SALT obligations. Under the new rules, they deduct $40,000 instead of $10,000, saving $7,200 annually in federal taxes. That's real money that allows them to afford even more expensive housing, perpetuating the cycle of geographic wealth concentration. The housing market implications are particularly concerning. The SALT expansion effectively subsidizes expensive housing markets by reducing the after-tax cost of high property taxes. This creates artificial demand for expensive real estate in high-tax areas, potentially inflating property values further and making housing even less affordable for middle-income families. The business investment effects are equally problematic. Companies considering where to locate operations now face distorted tax signals. High-tax states can maintain elevated business tax rates, knowing that many business owners will receive federal SALT deductions to offset the burden. This reduces pressure for pro-business tax reform at the state level. The municipal bond market implications deserve attention as well. The SALT expansion reduces pressure on high-tax states and localities to control borrowing costs, since wealthy residents receive federal tax benefits that partially offset the burden of financing higher debt levels. This moral hazard could lead to increased municipal borrowing and higher long-term fiscal risks. I'm particularly concerned about the intergenerational wealth effects. Wealthy families in high-tax states can now preserve more wealth annually through SALT deductions, allowing for greater accumulation and transfer to heirs. Meanwhile, families in low-tax states who made deliberate decisions to live in fiscally responsible jurisdictions receive no comparable federal assistance for their wealth-building efforts. The small business impact reveals another layer of geographic inequality. Pass-through entities like partnerships and S-corporations are subject to additional restrictions under the new law, potentially offsetting some SALT benefits for business owners. However, these restrictions primarily affect sophisticated business structures more common in high-income areas, creating complex planning opportunities that benefit those with access to premium tax advice. Looking ahead to the 2030 sunset, I predict a massive political battle that will divide the country along geographic lines. Representatives from high-tax states will argue that reverting to the $10,000 cap constitutes a targeted tax increase on their constituents. Representatives from low-tax states will argue that extending the expansion forces their constituents to subsidize the tax preferences of coastal elites. The lobbying effort to extend the SALT expansion beyond 2030 is already beginning. Wealthy taxpayers and municipal officials in high-tax jurisdictions are organizing political support to make the increased cap permanent. They argue that the federal tax code should accommodate different state policy choices rather than penalizing high-service, high-tax communities. This argument ignores the fundamental unfairness of forcing taxpayers in low-tax states to subsidize those choices.